Hello and welcome to this edition of Opening Bell on Money Control. Well, it's a difficult Friday morning. It was an extremely difficult night. Our armed forces, have been battling misadventures from the Pakistani side throughout the night, and the situation continues to unfold even now. First and foremost, I would like to say that our thoughts and prayers are with the brave men and women of the armed forces who are valiantly defending the nation's sovereignty and ensuring the safety of all the citizens. We also stand in solidarity with those stationed along the line of control, praying for everyone's safety, really. But the battle, isn't just, limited to the border. We're also fighting a war of misinformation, so to say. There's a lot of unverified content circulating on social media. In fact, the government has also issued an advisory urging citizens to rely only on official sources. It's crucial not to fall, prey to unverified claims. As for the markets, a lot to digest. I don't know whether the markets were actually factoring in an escalation of this magnitude. The GIFT Nifty is already hinting at a gap down start. Although last evening, when the situation was unfolding, the GIFT Nifty was down somewhere around 500 points. It has recouped those losses. In the morning as well, when I checked early morning, it was down 300 points. But as of now, it's down somewhere around 180 points or thereabouts. But I think, more than about levels, it's going to be about sentiment today. The sentiment has been upbeat as we were focusing on trade talks, trade deal with the UK, so to say, and, how things are unfolding in terms of tariff with the US as well, in terms of a deal. So a lot was, a lot of emphasis was being laid to that. But now with the escalation in this conflict with Pakistan, it will, the sentiment of course will take a hit, as we saw yesterday in the fag end of the trading session, when the Nifty in fact came off 250 points from the day's high. It was a deep gash, and today as well, brace for a fair bit of volatility as the situation along the line of control unfolds. But before we decode the situation with our experts, let's take a look at the top headlines at this hour. India neutralizes Pakistani air defence radars and systems in several locations in response to Pak attempts to attack military facilities in Srinagar, Pathankot, Amritsar, Ludhiana, Chandigarh and other locations. No casualties or material losses have been reported. Pakistani Rangers resort to unprovoked cross-border firing along the international border. Explosions were heard near the line of control. Armed forces are retaliating effectively. Defence Ministry says India remains fully prepared to defend its sovereignty and ensure the safety of its people. Amid rising cross-border tension, schools, colleges, universities to remain closed in Jammu, Punjab and Himachal. In fact, a lot of airports, in sensitive cities have also been shut. And of course, we will also have a briefing by the Defence Ministry shortly, updating us on how the situation really is unfolding. And the United States Vice President J.D. Vance says that India-Pakistan tussle is not the business of United States, but added that de-escalation was the need of the hour. He said that the United States will not get involved in the middle of a war, but at the same time, U.S. Secretary of State Marco Rubio is in touch with External Affairs Minister S. Jaishankar. So can't really say that it's a hands-off approach from the US when it comes to this entire conflict. But the latest India-Pakistan tensions continue to simmer. Indian armed forces foiled fresh attempts by Pakistan to strike northern and western Indian cities using drones and missiles. According to the Ministry of Defence, Pakistan launched drone and missile attacks on Indian military stations in Jammu, Pathankot and Udhampur. However, India swiftly neutralized the threats using both kinetic and non-kinetic measures, with no casualties or damage reported. Now, defence sources confirm at least 45 to 50 drones were shot down from Ladakh to Bhuj, and India's S-400 air defence system successfully blocked incoming projectiles, including 8 missiles aimed at key locations like Satwari, RS Pura and Arnia, and military installation in Leh and Srinagar were also targeted. Now, in response to the threat, as I mentioned, airports across the country have also been placed on high alert. Meanwhile, US Secretary of State Rubio has urged de-escalation while reaffirming America's support for India's fight against terror. Well, on that note, quickly take a look at the cues for trade. The GIFT Nifty hinting at a triple-digit cut, a 180-point cut to be precise at the start. You still have 7 to 8 minutes to go for the markets to open. Yesterday, we saw deep gashes in the second half of the session. When the PIB release mentioned that Indian forces have neutralized, Pakistan air defense system, especially in Lahore. The escalating tensions took a toll on sentiment, and we saw deep gashes coming in. In fact, the broader end of the markets also plummeted, with the mid-cap index down somewhere around 2%. It was a fairly range-bound session until then. But once the news started trickling in, we saw the markets take a sharp turn. Overnight, Indian ADRs fell sharply in US trading. If you look at the banking ADRs, ICICI Bank, HDFC Bank, all of those ADRs slumped 5% each. Even Infosys, Wipro, Dr. Reddy's ADRs were down anywhere between 1 to 3%. And a very important factor to note is that India VIX, the fear gauge, has shot up, over 10%. It hit 21. In fact, it went past the 21 level as well. These are the highest levels that we are witnessing since 9th of April after the announcement of reciprocal tariff by Donald Trump. Now, India VIX has jumped 43% since April 22nd, when the Pahalgam attack took place, indicating heightened nervousness. And of course, as I mentioned, it is playing out, and today more than levels, 24,000 in all probability will be breached, but more than levels on the index, it will be more of how really the sentiment has been impacted. Even the rupee market, the money market, so to say, saw a knee-jerk reaction. Rupee saw a big fall. It slid nearly 1.5% to end at day's low. It was the biggest single-day fall for the rupee in over 2 years. In fact, even the bond yield saw a spike. In terms of the equity markets, the market breadth worsened. Advanced decline ratio was on the NSE was at 1:3. 45 Nifty stocks ended in the red, and stocks fell anywhere around by up to 4% or thereabouts. But I want to see if we have our first guest on board with us or not. I had requested Mr. Sunil Subramaniam, a big market voice, to join in and understand the situation and what kind of reaction we can expect in the wake of the escalating tensions. Sunil, lovely chatting with you, and thanks a lot for responding to my late night call to you. Sunil, were the markets really factoring in this level of escalation? Because till now we were looking past, the retaliatory action by India, which was non-escalatory in nature. We were expecting some bit of retaliation from Pakistan, but were we really expecting or factoring in, this kind of escalation?
I think as a defense forces, I think so, because whatever the attacks Pakistan have tried against us, we have repelled them. And I think we've been proactive. So I think from a defense, while the nation itself maybe would not have been expecting that, but I think the defense establishment clearly has been on their guard. And that's clear because we have repelled every single one of those attacks. So I think from the military perspective, right, I think they've realized that since we have hit the nerve center of what they were supporting, they were expecting a kind of reaction from them, and they were prepared. So I think, but probably as a nation, as a market, as a public, we are probably taken by surprise, because we thought that just like Balakot and Uri, that Pakistan would just not react to this. But clearly the damage has been far worse there for them to then react.
Sure. In terms of the market, really, I think, as I've been saying, it would be more about sentiment rather than levels, because, a knee-jerk reaction is expected, because in the pre-open, I can see the Nifty is down somewhere around 340 points or thereabouts, 23,930. That's where it's at. But, do you think sentiment will take a hit in a big way? And would you expect a fair bit of panic selling today?
So I would say that there's a fight between India and Pakistan, but there's a fight in the market between a short-term hedge fund and a domestic trader versus a long-term investor. Because yes, I saw the data yesterday also. The net FII flows were 2,000 crores positive. So what is that? I think that there's been a massive amount of selling by short-term hedge funds, and at the same time a compensatory buying by longer-term sovereign wealth funds and pension funds and insurance. And the reason for that is very simple, right? Because I think the hedge funds, if you see from April middle is when they've started entering India, with the crude price fall, with the dollar weakening, and expectation of a US recession leading to an expectation of rate cuts, right? So that's made the sentiment positive, and I think a lot of them have entered over the last 3 to 4 weeks. Now, a hedge fund typically varies from a week to maybe 3 months in terms of their call, right? So for them, when they see that they've already spent 15, 20 days in the market, and then the next 15 days the volatility will be there, some of them may be booking profits and taking out the money, which is very natural and which is what the fear and the greed. But at the same time, I see longer term investors stepping in to control that. So this is a balance now. So today, because of the escalation of yesterday, I expect that to continue. You will see intensified selling by shorter term investors. How far the longer term investors see and wait for a price correction before they re-enter, that's what is going to induce the volatility. So I expect the volatility to be sustained for some time. How far the market will fall today is essentially decided by these long-term players, because they will be tracking individual stocks and sectors. And as we are aware, despite the fall, the large cap index is still around about the long-term valuation. It's still not coming to cheap value territory. So they will be looking at specific stocks and sectors, and if they come down, they will step in to buy. But at what that point is obviously spread over a large number of stocks and sectors. So we'll have to wait and watch.
Okay, wait and watch. That's the approach. Hold that thought, Sunil. We also have Raja Venkatraman, co-founder of NeoTrader, joining in. Raja, great to have you joining us this morning. Important morning. Of course, we are awaiting the market open. In the pre-open, we are seeing a 350 point cut. Although it will be more about sentiment and less about levels today. But if I were to ask you to pinpoint a support level on the index, what level on the downside would you look at for today?
Yeah, good morning, Nandita. Very rightly said and very aptly said that right now the levels are not so much of importance compared to the sentiment. But then when you take a look at the entire market scenario that has been unfolding over the last few days, there has been a clear hesitation at the higher levels, and that's what is prompting this reaction at the moment. And lower levels will continue to be bought into because our market is much more stronger and resilient. So the dips are to be considered as an opportunity to buy into. But then, the earlier guest, we got to wait and watch what really happens today. So I would take a closer look at around 23,600 to 23,700 as an important support zones. And I'll be tracking the Nifty spot because that's where the whole tracking I do. And I find that around that zone, it's a very good buying area. But I look at that if the market dips and if it comes into that area, then it will be a good area to buy into. But then looking at the kind of excessive selling sentiment which is there right now, I think that it will be a flash dip. And then the markets will tend to consolidate at the moment. So right at the open, the markets are opening gap down. But then I would wait for the first half an hour for the market to settle down to take any course of action.
Okay, first half an hour of market action will be crucial. On that note, the first ticks are coming in. It is a 200 point fall. Last evening the GIFT Nifty was down 500 points. So it's not that magnitude of a fall, but it is a 200 point fall on the Nifty. We are defending the 24,000 level as of now, but we'll have to see how much of a panic selling we end up seeing, because we have the briefing from Defence Ministry as well slated later in the day, sometime soon, so to say, shortly. So a lot of cues will be coming out from there as well, but we have still managed to recover from opening lows. We are now down just about 140 points. We fell somewhere around 140 points yesterday, although we came off 250 points from the day's high, and right now we have managed to cut some of those opening losses and are down somewhere around 150 points. The mid cap index, a measured fall there as well. It's a 0.7% kind of a fall there. Yesterday, the magnitude of fall on the mid cap index was more pronounced. We saw a 2% cut on the Nifty mid cap index. But yes, weak start, but not as weak as one would have anticipated. Advance decline ratio is extremely poor. Early days to actually call it a trend, but 1:13. That's the Nifty advance decline ratio. 127 advances to 1700 declines. I want to see in terms of the rest of the market how things are really panning out when you look at the sectoral action. Yesterday, most of the sectors ended in the red, barring the IT pack, I think, that managed to hold on. But of course, today the weakness is broad based. So I'm guessing, yeah, all the sectors, in fact, are trading in the red. But the cuts aren't all that deep. If you see the sectoral laggards, they've all lost some around 0.8% to 1%. It's not like a 3-4% cut on any of the sectors. Only the realty pack is down 1.5% or so. In terms of the Nifty movers, there are only 3 or 4 gainers, so to say. One is Tata Motors. In the wake of the US-UK trade deal announcement, it was supposed to gain any which ways, and it has been on a gaining trajectory as well over the last couple of sessions. Bharat Electronics from the defense pack, standing out as a gainer. L&T, good outlook. It reported its numbers yesterday. The stock is up 3.5%. The guidance has been good, and the stock is reacting to that. Titan as well came out with its numbers, and it's reacting to that. So a very slim list of gainers at the current juncture. And looking at the laggards, just want to point out a few movers. Power Grid, Eternal, Adani Ports, Geo Financial, Coal India, Asian Paints. These are some of the laggards. So all in all, yes, it is a weak start, but at this current juncture, the fall is looking a bit measured. Sunil, what should be the capital protection strategy right now? More than logic, there's a lot of emotions at play, and a knee-jerk reaction is to sell out and raise cash and sit on cash. Should that be the capital protection strategy now?
Not really. I would say that if you now look at it from a existing investor perspective who has fully invested in the market, right, versus somebody who has kept some cash on the sidelines, I would say two different setups. So somebody is fully invested in the market. If you want to take out some money from the market, right, it's not a really good day to do that, right? So I would say that you hang in there. You just control your emotions to avoid panicky selling, right? Unless, of course, you have a need for the money, which means you're taking the money out of the market. I'll leave that out of sight. But if you're sitting on some amount of cash, I know there have been a lot of investors, domestic fund managers, for example, are sitting on over 200,000 of cash. So I would say that's the money where your best strategy is to deploy a small proportion of your capital. As an individual, I would say 1% of your free cash, right? Put it in, but hang around quality, hang around larger companies, right? With this frame in mind, that's the best capital protection, because these are the companies which will not fall that much, but because of the nature of the volatility, there will be it's a good price point to buy into, and which they will also bounce back. Whereas anything falling very deeply may take a bit of time to come back up the top. So I would say deploy a small proportion for an individual investor, probably 1% of their free cash, but consistently deploy it every day a little bit. But stick to the quality as a paradigm, and ipso facto larger companies. I'm not saying large cap necessarily, larger companies even within the mid cap space as your best defensive strategy, if you so call it. But you will still be participating in buying good quality at a cheaper price than you got them a few days ago.
Sunil, would you like to take us through which pockets one should look at? I know we've been having these conversations on a daily basis, but for the benefit of our viewers, if today was the day to deploy some cash, which are the pockets they should look at?
So I would say two major factors which are driving this, right, nothing to do with the war, are the oil price drop and a positive RBI rate cut outlook. If you keep these 2 points into mind, clearly BFSI stands out as a beneficiary, and consumer discretionary stands out as a beneficiary. So I would say that because consumer discretionary stocks also tend to benefit from the import prices of crude related derivatives coming down, and at the same time, the budget giveaway on the tax would mean that there could be some amount of positive buying happening in terms of the high-end durable segment. So I would say stick to BFSI as well as to consumer discretionary, or buy a broader consumption fund, I would say, because FMCG will come into a fund, but maybe from that point of view, from a growth perspective, FMCG may not be, but defensive wise it will help you. So that's my best way, is probably rather than go and pick individual stocks at this point in time, pick a good financial services fund and pick a good consumption fund. That's the better way to play this, because both of them are not related to the war too. So the temptation to go and buy defense in time of a war, right, is a sentimental thing. I'm not sure it's yet fundamentally supported.
Yeah.
So I would say stay away from that because you're just going to see a bounce back on defense, but it's probably not fundamentally something that you should look at right now.
Okay, fundamentally you should not look at defense right now because that will only be in knee-jerk reaction to what's unfolding across the border. But technically, Raja, what do you look at? Do you look at defense technically at least?
Technically, defense has been playing around quite well, and over the last few days, the defense sector has been showing some promise. And amongst them, as a trading bet, yes, you can look at HAL compared to BEL, though BEL has a positive news. Yes, as a trading bet, HAL definitely looks well on the charts, and over the last few sessions, they have been holding on to the higher levels above 4,000, and it looks like it's poised for more upside. So even today, it began the day well, and I think that it has potential to cross 4,600 by the end of the month. So it's a good play for a multi-day play.
Okay. All right, that's the word. But, coming to you, Sunil, on the FII sentiment, I know you alluded to it briefly, but, FIIs have already covered a lot of short in the system. In fact, they were going long. Any risk of long unwinding when it comes to FI positions in index futures now? Because as I mentioned at the start as well, the focus was more on the trade side. But with this escalation, yesterday the news came a bit late in the day. So 15 straight sessions of pumping in money in the Indian market, and $5 billion worth of of funds invested in India in the matter of a fortnight. But any risk of that reversing, at least till the situation stabilizes here on?
So I would say is that if you look at it for me, it's the interplay between a short-term FII and a longer-term FII. So I do think that if the war situation continues for some time, there would be a temptation for the short-term hedge funds to book profits, right? But at the same time, I expect the longer-term sovereign wealth funds to continue to look at bargain picks within their space, right? And that's why for me BFSI, when I mentioned, because 35% of the large cap index is BFSI. So that's where then they would tend to buy. But to predict that when these longs will get unwound, right? So from a hedge fund perspective, right, it depends on, I'll tell you what's the issue, right? We are looking at the Indian media, and obviously the coverage is India oriented, but internationally Pakistan is doing a lot of misinformation. They're claiming to have shot down Rafale. They're saying India attacked ourselves. So to a foreigner, he's looking at and he's trying to look at BBC, look at Sky
It's a
News,
war of misinformation as well, it looks like.
Right. So to a short-term hedge fund manager, to the extent he says, oh, if I assume even 10% of misinformation is true, is that something that India is hiding? So there will be a negative nurse reaction, and somebody who says, I'm in the money today, and I in 1 week later I may be out of the money, so might book profits. It's not sentimental. It's a very tactical call saying, I took a short-term call, I have made money. Now do I get out and book my profits? I can re-enter later. So I'm saying that kind of volatility will be there, and one must be prepared for that. So the net numbers is what we see, right? We don't know how many long-term FIs have come in, how many short-term have gone in. So this balance between the two, right? I think is that. But that being said, right, like I said, what is the worst case scenario? Why would even a short-term want to book profits, right? It's if he's trying to guess the other short-term players' intentions. You get my point? It's not about any damage to India or to the financials or to anything. It's about saying, oh, if there's going to be a domino effect on other hedge fund managers selling, then let me go in before they sell and book my profits. So it's more about trying to outthink the other short-term players in the market, and that's a constant thing. That's one. Second is the algorithmic traders. They tend to feed in certain key variables into the picture, right? So one of the key things which probably they will look at is, because of this or war-related spending, right? Is India's fisc going to be under any stress? Because we have clearly indicated path of an improving fiscal deficit. Now, because of this war, are we going to have to rejig the budgetary allocations? So it's something they will factor in. If they put a probability to that, then those numbers will change and some algorithmic selling may happen. So these are all unpredictables, but I'm just saying that one has to be prepared that while we look at medium term India as positive, not every person there is looking at it as entirely positive, because they have come in at certain levels with certain expectations. And they have certain short-term outlooks. So within their horizon of time, if there is something which is going to, volatility going to sustain, somebody will take profits off the table. So it's a part of the normal healthy market. And from a longer term investor perspective, I think this is a wonderful opportunity to buy small bits. Keep nibbling at the good quality stocks is, I think, your best ever protection that you can do.
Any thoughts on the money markets, Sunil? Rupee, as I was mentioning yesterday, saw its biggest single day drop in 3 years. Yields also spiked. What are the major concerns emerging when it comes to the money markets as a result of this conflict, escalating conflict?
So I think that impact is essentially dependent on the RBI. As far as I was aware, the strengthening of the rupee a few days before, RBI was not so happy with it. So my sense is that this rupee's weakening is something RBI is allowing to happen. See, and so I don't think that they will go and defend the fall. And when they defend the fall is where they suck liquidity out of the domestic money markets. So I see that from an export perspective, RBI was not very happy. It's my own read of it with the strengthening of the rupee, right? Because when we are trying to increase our exports and build a case, the strengthening was not really. So from that point of view, any depreciation that's happening, and why is this happening, is because of covering by the traders, because FI flow is still net positive. So you can't say that FI is pulling out money caused this weakening, right? Because the net number of FI was positive. So from that point of view, I would say that RBI will allow a certain level of healthy depreciation. So only when the rupee falls to a level where they feel the need to defend it, will you have an impact on our money market, because that will mean they will suck out liquidity from the market to buy the dollars, right? So it's not yet at that stage, but you have to keep watching and observing this situation. So it's RBI which is essentially going to decide the money markets whole situation and fate on what happens then.
Sure. Very well explained, Sunil. But coming to you, Raja, let's talk about some of the stocks that are in focus and that are really managing to buck the trend in reaction to their earnings, and also Tata Motors for that matter. Third straight day of solid gains coming in on Tata Motors. Of course, there's this UK-US trade deal, the first of many that Trump has hinted at, has been announced. In fact, the deal Trump says will bring UK into economic security alignment with US, and the final details will be written in the coming weeks, and the UK will fast track US goods through customs. These are the words of Donald Trump. But Tata Motors, stands to benefit. The stock has been on an up move, a very solid up move. Today it is extending its gains. What would you do with the Tata Motors at the current juncture at 697, almost 700?
Yeah, right. So considering the mixed reactions which we are seeing in the auto space, there is still some bit of positive traction that we are able to see in certain stocks like Tata Motors, TVS. So I find that Tata Motors, along with this positive news, is definitely poised for some upside here. And the reaction yesterday was a good area to buy into. And now today with this news flow, I feel that it is now poised to move above 700. So a move above 700 will augur well for the prices. And looking at the overall setup, one could do a trade for a multi-day play towards 720 to 725.
Okay, 720 to 725. That's a level to watch out for on Tata Motors. But L&T, good, results. The stock is up somewhere around 4%. It's good to see that stocks are actually holding out and reacting to micros as well. I just want to take you through the numbers of an L&T. If you can just fire the chart. The profit has risen 25% on a year-on-year basis. Revenues have grown 11%. Margins have also come in higher at 11% vis-a-vis 10.8% on a year-on-year basis. In terms of guidance, top line growth is seen at 15% and core margin guidance is seen at 8.5% vis-a-vis 8.3% in FY25. Margin for L&T has been an area of concern, but they've guided for higher margin growth going forward. Order inflows are seen at a growth of 10% for FY26, and international market momentum order inflow will continue going forward. They've also said that FY26 pipeline looks encouraging at the start of the year. The initial estimate of order prospects is 7 lakh crores for domestic and 12 lakh crores for international. So yes, a 4% uptick, looking good. Is this the start of a fresh breakout move on the charts of an L&T, Raja?
Last 6 months, L&T has been facing a lot of headwinds, and now finally, after so much time, you are getting a tailwind actually in L&T, and this is clearly spelling some strong upside here. And the breakout today, after a phase of again considering the nature of the market, the consolidation, this breakout is quite good, and one can consider it as a trading, as an investing bet in L&T. The targets of around 4,000 is very much possible in the next 6 months.
Okay, that's the view on L&T. It was stuck in a range, but it is witnessing good moves today. Titan as well, top Nifty gainer, shining bright. Net profit up 11%, revenue up 20%, EBITDA growth almost 30%. Margins also higher at 10.7% on a YOY basis. One would have said that gold demand would have taken a hit, in the wake of the kind of rally that gold prices have seen. But the company's numbers, have, kind of weathered that pretty well. The stock is up 4.5%. At this juncture, would you be a buyer? What would you do with the stock? Or would you look at booking partial profits?
Yeah, when you take a look at Titan, again, Titan has what we are seeing today is that the ones which have come out with decent set of numbers are the ones that are performing. And today again, Titan has demonstrated once again that if the numbers are good and if the market is holding its ground, the buying is going to come into, and that's what has happened in Titan. Yes, looking at the history, there has been some shorts that have got built into ahead of the numbers, and the shorts are getting covered right now. So one should wait for a pullback in all these stocks, because the stocks which we have spoken today, they were all shorts getting built, and also the nature of the market over the last 2 days had prompted some short build up. And the after the numbers, the first reaction will be the short covering. And looking at the nature of the market, one can expect a pullback into the morning lows, and then wait for the buying. But then all the three stocks are a buy from my side, and they are having good prospects now in the coming months.
Okay, good prospects for a Titan in the coming months. But, I want to quickly touch upon the capital market stocks as well. Exchange related stocks. BSE had seen a fantastic run recently. Today, of course, taking a breather, 3% down on BSE. MCX, came out with numbers, but the stock is down 6%. In the wake of the volatility, how would you look at capital market stocks on the charts? Do you expect the stocks to, come under pressure, at least in the short term?
Yes, see, stocks coming under pressure is largely due to the current market scenario. And as long as the current market scenario is unfolding, we may experience some bit of pressure. But then the financial stocks have performed reasonably well. And, the earlier guest as well as across the channels, people are voting for financial sector as a sector which we have to get into. So we won't expect much. You can't expect much reactions in this sector. So any dip which comes in, you can keep participating, because BSE, like everyone knows, has gone up almost 2,000 points from the lows in April. So the promise continues to be good. The results are also encouraging. So overall, prospects are good. So BSE, beat MCX, beat CDSL, all these stocks are going to perform quite well. So every dip is a buying opportunity in the stock, and it's not a call for exit.
Okay, every dip buying opportunity and not a call for exit. But, what would you do with some of these auto part makers, the likes of RK Forgings, Bharat Forge? After the 25% US tariff, all these stocks came under pressure. But, of course, a deal maybe on the horizon with India as well pretty soon when it comes to US, and we had the UK trade deal as well. So, queues are plenty. So, how do you navigate some of these auto part makers now?
Yeah, the auto part makers definitely are facing the brunt of the tariff. And at the current juncture, the way the things are panning out, it definitely demands us to at least exit partially, because overall sentiment is definitely ruptured. Now, even post
Hmm.
whatever deal is going to be struck, the recovery process is going to take longer. So unless we
Hmm.
have adequate capital to get locked in, it's better to look at some other sectors that are moving, like the earlier sector which you spoke of, financials, or
Hmm.
some of the auto names, or the stocks which are come out with good results and come out of hibernation. So those are the kind of stocks which one should get into. So
Hmm.
there is going to be some stock specific action that is going to emerge in this particular quarter, because the results have been a mixed bag, but then there are definitely a lot of encouraging results that are coming in as part of the Q4. So I would say that
Hmm.
it's going to be a very stock driven market rather than an index driven market, because index is going to
Hmm.
take its time to find its feet for the next few days.
Okay, be stock specific. Index will take some time to find its feet. That's the view. But before I let you go, Raja, any advice to traders and investors as to how to navigate this volatile situation that's still unfolding, and one doesn't really know when the situation will settle down, so to say. Battle of nerves as well. A lot of emotions and logic kind of tends to take a backseat at such times. Any particular advice that you would like to give to our viewers?
Yeah, both of us have been on the same page as far as the sentiment is concerned. So I feel that at the
Hmm.
current juncture, the sentiment is definitely calling us to exit our portfolio, go for the shorts. But I feel that going short into the market right now would not be a good idea. As a trader or as an investor, I would like to wait out today. Today is the last trading day of the week. We are going to head into a weekend, and we don't
Hmm.
know what's going to happen and what we can expect on Monday.
Hmm.
So if you have the capital, then you can invest some portion, because like they always say, when there is sale in the market, nobody wants to take the sale, but they will always go on Amazon or Flipkart. But market is a
Hmm.
place where you should invest in the time of sale if you have got the money. If you don't have the money and you do not want to do anything, wait out today and wait out for a couple of days. I'm sure that the dust will settle down. Yes, a lot of dust flying around, but then the kind of structure which we have as part of the country, I'm sure that we are quite more resilient compared to the earlier. And if you've seen the news feed, they clearly said that
Hmm.
this time India is not giving a very soft reply; they were giving a hard stance reply,
Hmm.
and I'm sure that the market will also respond in the that tenor.
Hmm.
So I feel that after a couple of days is where one should start participating if it were. Till then, I would like to wait and watch.
Hmm. Wait and watch. Yes, India has given a sharp reply, but that has been non-escalatory in nature, and India has the overwhelming support of global allies as well. But with that, Raja, I would like to thank you for taking out time on such a momentous day and sharing your thoughts with us. I'm sure our viewers will also take away a lot from the advice that you've given, as to how to navigate this volatile situation.
Yeah. Thank you.
Thank you. On that note, I mean, before I bring on board my next guest, I want to take stock of what India VIX is doing. The fear gauge that's shot up 6%. It's above that 22.2 level. Yesterday in the second half, we saw the India VIX shoot up 10 to 13%. Today, another 6%. So yes, there is that fear factor looming. Although the selling hasn't been all that bad that one would have anticipated. It is volatile. We are seeing a sell off of 150 to 200 points within that range, but it's not the kind of knee jerk sell off that one would have anticipated looking at the GIFT Nifty last evening when the situation was in fact when the entire situation really started. But on that note, let me bring on board our next guest for today. Joining me is Anand Rathi of MIRA Money. Anand, lovely to be chatting with you. Your first thoughts on the impact on the markets of the situation that has been unfolding, unprecedented. Here on, how badly would the sentiment be affected? Because in the past, we've seen markets have taken Uri, Balakot strikes, within their stride. But this time around, would it be difficult or different rather?
This time around, I'm not sure whether it will be very different. Yes, the volatility will definitely go up significantly because this doesn't look like those regular surgical strike that we have seen in the past. This more looks like a 1999 Kargil war. Of course, that was more localized, but this more looks like that. So markets can give up some of the gains that it had accrued in the last couple of weeks or maybe a month or so. So our view is that the volatility will definitely increase. But with situations de-escalating, I'm sure both the economies cannot afford to have long-lasting war, if at all. So if that escalates down, Indian market should definitely pick up significantly from there. So downside expected, but recovery is expected to be faster than the downside.
Okay, recovery expected to be faster than the downside. That would sound soothing at the current juncture. But there's one question that I asked Sunil as well, and he recommended measured or calibrated way of getting into pockets that are largely unaffected at these prices, unaffected to the situation that's unfolding, and lower entry points, and nibbling in a calibrated manner. But when it comes to capital protection, what is the big, or what is that one cue that you will watch out for before acting on either side?
See, while anything ad hoc on equity is generally detrimental to the portfolio, so you shouldn't be taking any major tactical calls. You should rather take strategic calls. For example, today, whether there is war or no war, mid and small caps continue to be a little more on the expensive side. Large caps continues to be on the moderate valuation side. It is not cheap either. So our view is that strategically you should have more allocation towards large caps. But one of the things that we are missing, or most of the investors today are missing, is debt. The debt rates today are, even after the fact that repo has been cut by over 50 basis points in the last couple of quarters, I still think the debt is something that one should add because the interest rates can go down reeling from here by about 1% or so. So that is one strategic call that one should take, because that will also, it actually does two things. One, it helps you to diversify your portfolio outside of equity. And the second thing is, if things go right, we may actually see positive returns on debt as good as equity.
Okay.
Right, so in our view,
if you see, a lot of analysts have been pointing out that such volatile times are also very crucial or an opportune time for portfolio building for the long term. So if I were to ask you to pinpoint certain pockets that one should use this opportunity to get into for the long term, which ones would you really pick?
For us, the thing is very clearly on the large caps. There are a lot of pockets of value, especially in the pharma, in the banking sector. Let's say as a contra call, if it corrects even further thanks to the US economy, I think that is one pocket which can be of good use to be added for the next maybe 2 or 3 years or so. So these are the three pockets that we are very clear about. One of the longer term story definitely is consumption. India is a consumption economy with a lot of factors working in its favor, whether it is from the finance minister, whether it is from the RBI governor, inflation front, rural economy front. A lot of positive news are coming, especially on the consumption front. So our belief is consumption is a much longer story. You need to pick good values. Maybe in the initial couple of years, you pick more of stocks that will get impacted positively because of rural economy growth, and then pick out something that will get impacted positively on the urban economy growth. So you need to split your portfolio over a period of time. And consumption is a longer term story, while banking, pharma, maybe a contra call of IT is a shorter term story.
And should one be fully invested at the current juncture, or should one look at raising some cash and waiting on the sidelines as well, and deploying that money after this conflict is out of the way?
Exiting is very easy today. It's a very easy call saying that, okay, let me exit 5-10% of my portfolio. But you should exit only if you see heavy downside. So let me just give you a number. We actually worked on this even before the war actually started. Let's say if you exit 10% of the portfolio and the market only corrects 7%, right? Or 10%, for example, your impact on the portfolio is just going to be 1%. For 1%, the exit loads, the taxes that you end up paying, the additional costs that you would end up paying, and getting your timing right is actually not worth it. So until unless you see significant correction and you are okay to exit a sizable part of your portfolio, I don't think sitting on cash is making sense. Rather, add more money into debt, which will make your asset allocation a little more, saner. I mean, let's say 80% equity, 20% cash, or 20%, 10% in gold, something that which is better. Have a diversified portfolio, but don't sit on cash if you don't expect the markets to correct significantly, which we don't see it.
Okay, you don't expect a significant correction here on, and it's not advisable to really sit on cash, but look at diversifying your portfolio with other asset classes like gold, of course, which has had a record run and continues to be in focus. Because this is not the only conflict that we are seeing across the globe. There's a Russia-Ukraine war that has still been ongoing, right? But with that, Anand, would like to thank you for taking out time and joining in and sharing your thoughts. Look forward to connecting again, sometime soon as we take stock of the situation that's unfolding and the impact on the markets as well.
Thank you, Nandita. Good day.
Thank you. On that note, let's quickly take a look at what the markets are doing. We are actually hovering around that 24,000, 24,050 level. We've not breached that level yet. We'll have to see whether we remain in this 200-point loss kind of a scenario as the day progresses. The broader end of the markets have also seen a measured fall. It's an 0.8% kind of a fall on the mid-cap index. Yesterday, the fall was of a higher magnitude. We saw a 2% cut on the Nifty mid-cap index in the knee-jerk reaction when this escalation started coming to the notice. In fact, the Nifty Bank index is down somewhere around 1.2%. The advance decline ratio is, is poor, of course, but it's become a bit better than what we had at the start of the session. 330 advances to 2,000 declines. Most of the sectors are trading with cuts, but we have a few winners as well this morning reacting to earnings, and defense stocks, of course, needless to say, are gaining traction. Bharat Electronics being the top Nifty gainer, 5% gain. Titan reacting to numbers, 4% up. L&T guidance has been good. The stock is up 4%. Tata Motors once again extending gains, 3.5% gain there. Hero Moto and Dr. Reddy's. These are some of the other gainers. So all in all, even stocks are falling or gaining anywhere between 4 to 2%. It's not like a 7 to 8% cut on stocks that I have seen thus far. On that note, let me bring on board our next guest. Joining me is Nirav Karkera, Head of Research at FISDM. Nirav, great to be connecting with you again. Just a matter of 2 sessions, and look at how the situation has really escalated. To your view, do you think the market was anticipating an escalation of this magnitude? Because earlier, Uri, Balakot, we didn't see these kind of retaliatory measures from Pakistan that soon. In fact, we didn't see any. But this time around, they have taken resort to misadventures, and we have also been fairly unequivocal when we've said that we are not looking at any escalation, but the response is measured and non-escalatory in nature. And we also have the global, overwhelming global support to that extent. But here on, as a cue, what would you be watching out for? Would you say that here on the situation will only de-escalate, or do you think Pakistan will take recourse to more misadventures? Can it really afford to do that?
So, Nandita, like you rightly said, it's been quite some time, and by that I mean a very, very long time since we have seen a war play out to this extent and quantum, especially between India and Pakistan, right? So this has been unseen for several decades now, this magnitude and this quantum. So this is definitely, I wouldn't say it is a shock, but it is a very, disappointing escalation that has come our way. In fact, like you rightly said, India made its stance very clear on the fact that it was only targeting terrorist establishments, and any strikes on that India had initiated was in response to the Pahalgam attack, and it was still very measured and very clinical in its approach so as to ensure that no Pakistani military was harmed. But the retaliation seems largely uncalled for. Like the MEA has been briefing us constantly. Even last evening there was a press con where the MEA spoke at length about how it still intends to maintain peace but will not back down if Pakistan continues to aggravate the situation. So, considering the way the situation is shaping right now, I feel it is fair to say that it has not just escalated; it is now full blown war. I don't know about any
Hmm.
definition that would suggest otherwise, right? So, in a wartime situation, if you look
Hmm.
at the markets as well, it has been largely resilient. In fact, a very good comparison about the sentiments and investor confidence would be to look at how the Nifty has been reacting vis-a-vis global markets. Of course, I'm not going
Hmm.
to talk about what is happening to Karachi Stock Exchange, but even this morning, amidst
Hmm.
heavy warfare and clear escalation, Nifty was set to open with a very steep gap down of around 350 odd points.
Hmm.
But by the time the opening bell was the opening bell rang and Nifty went live, we had already covered around 180, 200 odd points. So there
Yeah.
is a lot of resilience.
Hmm. There is a lot of resilience. Yes, we can just see a 200 to 215 point cut on the index, and even the broader end of the markets are holding firm. 1% cut on the Nifty Mid Cap Index, but it's better compared to what we saw mid afternoon or at the fag end of the trading session yesterday. But Nirav, the next big cue to watch out for will be that IMF meeting that is slated for today. I wanted to ask this question to Sunil as well, but I think he didn't really have time. But what are your thoughts? Because Pakistan has sought $1.3 billion in funding from the IMF, and India has made it clear that it will urge IMF to exercise caution on the bailout package. Do you think the decision could go against Pakistan, especially the way they have escalated the situation despite global pressure to de-escalate?
So, this also came up as a part of the Q&A in the MEA's press con last evening,
Hmm.
wherein they made it very clear that India would definitely table the proposition for IMF to reconsider the bailout package and exercise excessive caution, right? But looking at the way, of course, it is anybody's guess what the outcome is going to be. But if one were to connect the dots and just pay attention to the United Nations stance on this entire
Hmm.
escalation of war and the several countries that have been coming in support against terrorism, as a fact, as a facet of the world. It is very clear that the tolerance for terrorism and terrorist aiding activities and such economies is not going to be tolerated by the world at large, at least not by the larger economies, right? Even supranational
Hmm.
organizations like the UN and others have been in very strong condemnation. It only makes sense for IMF
Hmm.
to also look at life from a very similar lens. So, because IMF is a supranational
Hmm.
organization with responsibilities spanning just economic packages, right? Or spanning, over and beyond just economic packages. So, definitely the end use of the bailout is something that we expect the IMF to be highly sensitive towards and to consider where is the money going to be used. In fact, the MEA also briefly spoke about how Pakistan has been routing funds in the past, that were initially sourced for developmental projects, but execution is yet to see
Hmm.
the light of day while all of this is happening. So, I feel there is a very strong case that India is going to present, and the IMF has all the reason to look at it with a much more nuanced point of view and probably
Hmm.
demand a few answers before releasing the next tranche of economic support.
Hmm. True that, Neerav, but also the fact that last time we spoke, in terms of strategy, I think we spoke day before yesterday when you said that, you could raise some cash in a calibrated manner. Would you stick to that, or would you also be of the view that, these bouts of volatility which are driven by geopolitics create good long-term opportunities? So is it the time to deploy and not sit on a lot of cash, or would you say that keep a proportion in cash while you deploy in quality stocks as well as other asset classes like gold?
So, Nandita, this is something I always say. Macro disruptions always create micro opportunities, right? So, the last thing you must be is faced because of macro uncertainties and geopolitical uncertainties. In fact, now is the time to be highly strategic. And as a part of our previous conversation, also I spoke about how one can start with considering an 8 to 10% odd cash allocation and recalibrate from there on, depending on their own investment objectives, right? So the idea of holding cash is not by liquidating equity at this point, but by ensuring that you have more cash earmarked towards deployment for equities, right? So if you do not have any cash and you're sitting on equity completely, it does not imply that you start cutting down on equity for cash. But if you are able to save more and cling on to more cash with the objective to deploy it at opportune moments, you must try and sit on more cash that way now, right? So I'm talking about additional cash infusion at opportune moments, right? So now is definitely a good time to be holding cash from that perspective. And we believe that this entire disruption is going to shake up several pockets in the market. It is not as if the worst is behind us. It is a developing situation, developing story. Different pockets are being affected differently. So as and when you start getting opportunities that align with your strategy, start deploying. But it is not a blanket buy right now. Definitely not that.
Okay, not a blanket buy. I want to get in your thoughts on certain, companies that have reported their numbers as well, because they are reacting, in a good manner. That's some bit of a, reprieve, so to say, on a day when the screen is largely throwing up red. But before that, of course, India within the emerging market is the brightest spot, right? And we are poised to overtake Japan as the fourth largest economy as well. But in the short term, do you see any economic fallout as a result of the situation that's unfolding? Even in terms of inflation, because farming across the border also gets impacted, the kharif crop, so to say. So all these factors put together, any economic fallout from this in the short term?
So, Nandita, there are going to be economic repercussions. In fact, it is going to be of meaningful magnitude. So, number one, this wars come at a cost, right? And the immediate cost is to the exchequer. So, the government coffers are going to be hit, right? The treasuries are going to be hit with every escalation in the war. Both sides, of course, we bleed a lot of money. Okay, so that's point number one. So there's going to be, a lot of pressure on government balance sheets. That's one. Number two, from a second order effect standpoint, like you pointed out, one effect is on the farming and agricultural, outcome that we were expecting to be positive in this year around, which the outlook for which could be moderated from here on in light of the developing situation. But having said that, inflation had only started coming under control, right? We were looking at moderated inflation. In fact, economic growth has been growing slowly and steadily on track. In fact, these were the premises for expectations of a rate cut also, sooner than later and of a magnitude larger than what was initially anticipated. So some of these premises are now going to be thrown into question. Life is not going to be easy from here on. Inflationary risks could emanate on the upside. So that is, definitely a fact. Again, amidst this geopolitical crisis, along with the entire tariff tantrum, in conjunction, exports are a very critical segment. Of course, there are bits and pieces of good news coming in through free trade agreements being signed and negotiations on the tariffs fructifying. But apart from that, the trade environment, especially cross-border trade environment, is definitely going to take a hit as airways and waterways start moving to high alert zones, and trade is not going to be as simple. So the economic growth trajectory, although positive, may see a sort of slowing down. I won't say it will get derailed or deferred also. It will just probably slow down from here on. But having said that, on the emerging market pack, India stands out very strong due to its robust, macros that are there. Of course, China may look, it may be a flash in the pan moment for China because a lot of negative was already baked in, and any sort of positive development between the US-China relationship could, flash indicators that signal positivity, but that does not take anything away from India. India remains strongly positioned in the EM pack.
Okay, India is strongly positioned in the EM pack, but if at all there is an uptick in inflation, does it, does it change the rate cut trajectory in any way? Perhaps delay further rate cuts by RBI, or do you think it's too early to say something like that?
So, of course, it is too early to comment on the inflation trajectory, but I feel I can, with decent confidence, comment on the expected reaction by central bank if inflation were to surprise on the upside. The central bank has, generally been very hawkish about inflation and, very sensitive to inflation trend. So, it would be fair to believe with a fair degree of confidence that if inflationary risks start materializing, the rate cut agenda could be at least pushed forward into the calendar. So, if the first happens, the second happens with a great sense of certainty. But what we can't comment on is how bad is the inflation going to shape up as an aftermath of the current escalations.
All right, that's the view. I can go on and on with questions, but Nirav, let's focus on some stocks as well that are in fact doing well today. The likes of L&T. I remember the very first conversation I had with you was about the entire capital goods space and L&T in particular, and we were talking about how margin pressure persists for L&T. But this time around, the margins have been fairly better, and the guidance is also looking good. How are you viewing the stock now, L&T? Do you think the margin headwinds are out of the way?
So, L&T has, in a way, given investors a sigh of relief after very, very long, after a rather, long period of pressure, because, see, the outlook was robust for L&T, since at least the past 3 to 4 quarters, right? There was very strong reason for L&T to turn around. However, due to execution challenges and efficiency challenges, it was not able to deliver upon the expectations. However, this time around, it seems like the theory is finally, playing out. This could be the very initial signs and green shoots for what we expect out of L&T. We are generally, optimistic about capital goods, and L&T is a formidable player in the space. We expect from here on a revival in, not just public capex and the private capex virtuous cycle kick in, of course, much later. It's not going to happen in a hurry, but L&T could be a key beneficiary, and especially now that operating efficiencies and execution pipelines seem more efficient. At this point in time, we believe that L&T will be able to pull this through the will be able to get much closer to its upbeat guidance in the quarters to come as well. So I feel at this point in time we view it favorably.
Okay, we are viewing L&T favorably. And lastly, Titan. In fact, since we are talking about Tata Group stocks, let's talk about Titan and Tata Motors. Tata Motors, I discussed with Raja as well on the technical front, but how are the stars aligning for Tata Motors, because the UK FTA, in terms of the deal signing with UK after like prolonged discussions spanning over years, that's come as a positive. Even the US UK deal seems to be a positive for Tata Motors. So here on, your thoughts on where Tata Motors is headed, and Titan post numbers, it is shining bright, although surging gold prices had hit demand, and one would have thought that it would impact Titan. But how are you viewing these particular stocks?
So Tata Motors first, of course, like you said, the US UK deal and the free trade agreement with the UK are definitely tailwinds, to Tata Motors, but having said that, we are not very comfortable as yet because of the entire JLR exposure to European and US markets, right? A lot of revenue sensitivity comes in from those markets, and the outlook, the demand outlook for those markets is, not pretty upbeat at this moment. So definitely, versus what the situation was probably, couple of months back, the situation has improved with the free trade agreements coming into place, and the trade certainty coming in. But the demand side of pressure, there's still limited reason to believe that's going to ebb anytime soon. So having said that, incremental and relative improvement, but challenges still persist. Structure, demand side challenges still, persist. At the same time, even for the domestic passenger vehicle sales, CV sales, we know that the domestic situation is also not very good. The domestic demand situation itself hangs in the balance amid escalation. So a combination of these demand side vectors are, it does not, in fact, restricts us from being very comfortable on the company's near-term prospects at least. Right. So that's for Tata Motors. Talking about Titan, one very good tailwind has been the gold prices. Of course, we believe there was wide-held belief that surging gold prices would hit demand, but it also coincided with something that is a magical period where law of economics doesn't hold up as much, is the wedding season, right, with which it
Yeah.
coincided over the past couple of quarters. So, although gold demand is expected to be price sensitive, but there is a certain degree of price inelasticity when it comes to consumer buying of, gold as jewelry, right? So, for Titan specifically, gold as a commodity, the tailwinds were sovereign buying and global, demand pushes. But for Titan specifically, domestic consumption demand is a very key vector, and that seemed to hold it in very good stead. Right, even going ahead, and of course, the increase in gold prices only supported, it was sort of a dual propeller to Titan for the past, quarter. Going ahead, also, we believe, the gold prices will remain, an accretive point for, Titan in the near term as well. But demand may slowly ebb, so we may not see a rerun of the last quarter in a hurry.
Okay, that's the view on both Tata Motors and Titan, and a view on a whole lot of issues. Neera, would like to thank you for taking this urgent call and joining in at the last minute. Always a pleasure chatting with you and getting in your thoughts. Helping us navigate difficult situations and sharing your thoughts with us as well as usual. Thank you. Thanks a lot. Let's hope the situation diffuses over the weekend, and we look at better and peaceful days in the coming future.
Looking forward
But
to a
would like to
positive
thank you. Thanks a lot.
Thank you.
Yes, we are all. Thank you. And on that note, quickly take a look at the market once before I wrap up. The selling has exacerbated a bit because we have slipped below that 24,000 mark, a 287 point cut on the Nifty. Mid-cap index is now down 1.5%, and Sensex has cracked somewhere around 900 points or thereabouts. Of course, a fair bit of volatility was expected, although we would still say that the fall is a fairly measured, given the kind of cuts that we were witnessing on GIFT Nifty early on in the morning. The advance decline ratio is at 1:9, 250 advances to 2,200 declines. Let's see how things unfold. But India VIX, the fear gauge has shot up above that 22 level. It was up 7% last time I checked. And yes, it continues to be volatile. But some winners in terms of earnings reactions: Titan, Tata Motors, BEL and L&T are also gaining, and Hero MotoCorp also on the gaining front. But latest on what's really happening in the capital, Defence Minister Rajnath Singh will be meeting Tri-Services chiefs in just a bit, and perhaps there will be a Defence Ministry briefing as well on how the situation has been unfolding. So all eyes will be on that as well. But as I wrap up, we at Money Control, we have our thoughts and prayers with the brave men and women of the armed forces who are valiantly defending our nation's sovereignty and ensuring the safety of all the citizens. We also, pray for the safety of those stationed along the line of control, and praying for everyone's safety. But with that, we are completely timed out on this edition of Opening Bell. Stay with us. Stay tuned to Money Control as we get you big market voices, big voices through the day, and get you the latest on how the situation has or is unfolding, across the border. So, keep at it. Keep, tuning into our website for, a lot of video interviews and a lot of, thoughts and, updates on our website as well. But with that, thank you for watching and, see you later in the day as well with Closing Bell.